Ever dreamt of escaping the daily grind? Trading in those cityscapes for some sunshine, maybe a slower pace of life?
Yeah, who hasn't, right?
Well, imagine this. You're successful, you've got the means, and you decide to split your time between your bustling business up north and a more leisurely life down in sunny Florida.
Sounds pretty idyllic.
Sounds like the best of both worlds, right?
Yeah.
But what does the IRS have to say about this whole two-homes situation, especially when it comes to taxes?
Ah, yes. Taxes. Always lurking in the
And
background.
that's where things get interesting. Today, we're diving into the fascinating world of taxes, residency, and what happens when those lines get a little blurry.
Sounds complicated.
It can be.
Yeah.
And to help us navigate this complex world, I've got our expert with me. So, are you ready to explore how lifestyle choices can have some pretty surprising tax implications?
Absolutely.
Hmm.
I think this is a scenario a lot of people might not even realize IRS complicated. It seems pretty straightforward at first glance. But it all boils down to this concept of tax home, which, let me tell you, isn't always as simple as it sounds.
You're telling me. And to illustrate just how tricky this can get, we're looking at a real court case, the case of Edward Andrews.
Ah, yes. Mr. Andrews. He was running two businesses, a pool construction company up in Massachusetts, and, get this, a horse racing and breeding operation down in Florida.
Wow, talk about a change of pace.
Right.
Quite a contrast. So 6 months up north, 6 months down south, enjoying the Sunshine State, all while juggling two very different businesses. That's already a lot to unpack. But what makes Andrew's case particularly interesting is how he handled his taxes, specifically those deductions for his Florida home.
Now, this is where things get really intriguing. He claimed that his Florida home was 100% for business use, because of the whole horse operation.
Okay.
And he depreciated the property and then started dividing other costs, like travel expenses, across different tax forms.
Okay, hold on. Depreciating a property, for those of us who aren't, tax savvy, can you break down what that actually means?
Sure. Depreciation, in the simplest terms, means deducting the cost of an asset over time, because it loses value, kind of like how a new car loses value as soon as you drive it off the lot.
Right.
In this case, Andrews was claiming his Florida home lost value over time because it was being used for business, specifically for his horse operations.
I see. So he was strategically allocating his expenses, trying to, shall I say, optimize his tax situation. But
Yeah.
was that allowed?
Well, that's the million-dollar question. See, you can't just pick and choose how you categorize expenses based on what gives you the biggest tax break.
Right.
There are rules. And as I mentioned earlier, the concept of tax home is central to this case. And for Mr. Andrews, determining his tax home, or should I say homes, is where things took an unexpected turn.
So we've all got a home, right?
Right.
But did you know the IRS has its own definition? And it's not as simple as where you keep your toothbrush, or in Andrew's case, maybe a saddle.
Exactly. The IRS, they operate on a whole different level. For tax purposes, tax home really means your main place of business, your primary workplace where the bulk of your income-generating activities occur. And this holds true even if you happen to be away from that location for extended periods, like Andrews was down in Florida.
Okay, so it's less about your physical address and more about where the core of your business is located. But if the IRS is looking at the main place of business, how did the tax court initially land on Andrews having two tax homes? That seems almost counterintuitive, doesn't it?
Yeah, it does seem counterintuitive, you're right. But the tax court's initial ruling likely hinged on the specifics of Andrews's businesses, both how he structured them, how he divided his time between them. Remember, he had these two very distinct operations, the pool construction in Massachusetts and the horse racing in Florida.
Right.
It's possible the tax court saw these as separate enough to justify the two tax homes concept, at least initially.
So they weren't just looking at the fact that he had businesses in two places, but rather at the nature of those businesses, how he split his time, all of that.
Exactly.
It sounds like a lot of factors come into play here. What did the courts focus on when trying to unravel this whole tax home puzzle?
Well, a key phrase you'll often hear in these situations is principal place of business.
Okay.
The courts really dug deep into which location, Massachusetts or Florida, carried more weight in terms of Andrews's overall income.
Right.
And just as importantly, the amount of time he dedicated to each business. They even look at things like where key clients are located, the overall significance of each operation to his income generation, that kind of thing.
So not all business activity is created equal in the eyes of the IRS.
No, not at all.
They're really trying to pinpoint where the heart of your income-generating activity lies.
Exactly. And it wasn't just about the money either. The courts also considered The purpose of Andrew's time in Florida, was it purely business, solely focused on those horses?
Uh-huh.
Or did it involve a personal aspect as well?
Okay.
Were there elements of leisure mixed in with his business activities?
So they were trying to determine if he was, squeezing in some personal time, enjoying that Florida sunshine a bit too much while tending to his racing operations.
Exactly.
It makes sense that the IRS would want to draw a clear line between business and pleasure, especially regarding deductions. But how did the appeals court ultimately rule on this whole two tax homes idea?
All right, so we've got this initial ruling of two tax homes,
Right.
which, as we've discussed, has some pretty big implications for deductions.
Huge.
But then you've got the appeals court taking a second look at everything.
Right.
What did they decide? Well, the First Circuit Court of Appeals ultimately overturned the tax court's decision.
Okay.
No two tax homes for Mr. Andrews.
Wow.
They really honed in on the fact that while he had business interests in both states, his primary source of income, the lion's share of his business activity, pointed towards Massachusetts as his principal place of business.
So even though he spent half the year in Florida, the appeals court said, nope, your main business hub is still up north.
Exactly. And their reasoning really highlights how important those factors we talked about earlier are: income, time spent, the overall nature and significance of each business operation.
Right.
They determined that Andrews' Pullet Instruction Company in Massachusetts generated significantly more income than his Florida horse racing operation. Plus, when they looked at the time he spent working on each business, it became clear that his focus and energy were primarily directed towards the Massachusetts company. The Florida operation, while substantial, just didn't carry the same weight in terms of his overall business activity.
So it's not just about having a business in two places. It's about where the core of your business truly lies.
Exactly.
And that can have some pretty significant implications for anyone who might be thinking of adopting a similar lifestyle, right?
Absolutely.
Yeah.
This case is a perfect example of how complex these seemingly simple terms can be. You might think, hey, I have a business in two states, I'm splitting my time, it's all good.
All right.
But the IRS has a very specific way of looking at these things.
Yeah.
And if you're not careful, you could end up on the wrong side of a tax dispute, just like Mr. Andrews.
It's a good reminder that we can't just assume we understand all the ins and outs of tax law, especially when you consider that most of us aren't dealing with two businesses and horse racing operations.
Exactly. That's why seeking professional advice is crucial. Tax law is nuanced, and what works for one person may not work for another. Consulting with a tax professional can help you navigate these complexities and ensure you're making informed decisions that align with your specific circumstances.
So what's the big takeaway for our listeners today? What's that one key point you want them to walk away with?
I think the biggest takeaway here is the importance of planning and understanding the nuances of concepts like tax home. If you're considering a similar lifestyle, splitting your time between multiple residences, maybe dabbling in different business ventures, don't just assume you can claim deductions wherever you please.
Take the time to understand the rules, seek professional advice, and make informed decisions. It might save you a lot of headaches down the road.
Great advice. It's always better to be proactive and informed when it comes to taxes. This whole case really makes you think, doesn't it? If the definition of home can be so different for tax purposes, what other commonly understood terms might have surprising implications that we should be aware of? Something to ponder, listeners. And that's a wrap on our deep dive into the fascinating world of taxes residency and the unexpected twists and turns of tax home. Thanks for joining us.